Welcome everyone to this Thursday conversation on Mango Spaces, right at the start of a pretty long weekend, 3-day weekend if you're in this end of East Africa, because tomorrow is going to be Labor Day. So you're going to have a nice long runway into the weekend. We'll be in conversation tonight with Jacqueline Karasha. She's the CEO and Principal Officer of SanlamAllianz Life. And we'll cover a broad range of topics, companies' financial performance, the rationale for transferring the general insurance business to things like medical insurance, car insurance, work injury benefits, and so on and so forth, moving that over to Jubilee, and much, much more, as well as the landscape of the life insurance business in this corner of East Africa. Jacqueline, thank you very much for making time for this conversation this evening. Let's start with you. Tell us about yourself. Tell us about your journey to getting to where you are today.
Thank you, Rama, and good evening, everyone. It's an honor for me to be here this evening and to have very insightful conversations about our business and the industry as a whole. And starting with myself, so Jacqueline Karasha is me. I have worked with SanlamAllianz now for 10 years, and I've been in the industry for now 20 years, specifically with the life insurance industry. I have a background in actuarial science, so I think it was almost natural that once we graduated, being the third, fourth class of actuarial students in the country at that time, that we joined the insurance industry.
So that was from JQuat, right?
Yes, from JQuat. And after graduating, I got into the insurance space almost immediately. And it's been a very exciting journey because through it, I have been able to work through various functions of insurance. I must say, when we started, life insurance was very unknown. It was the little known line of business across all companies. Most companies really were set up to be general insurance companies. And that's really what used to drive industry growth and profit. And actually, even Kenyans used to resonate a lot with general insurance products. And so throughout my career, I have seen the transformation of the industry. I have seen a lot of work going in terms of improving products, creating awareness. And I've had the pleasure to really work in different companies that I've learned a lot. I've met fantastic people and ended up at SanlamAllianz for now 10 years. So again, through that, since last year, I became the CEO of SanlamAllianz Life business, and I've been serving now for close to 9 months, Rama. I think I'm almost celebrating a year as CEO of the business.
So focusing on the business itself, because last year was quite interesting for Sanlam Kenya. The firm rebranded, and then on the 1st of November, there was this transfer of the general insurance business that moved over to Jubilee, and that left effectively Life as a core operating entity. What was the rationale for that shift to essentially say the general insurance business is interesting, and yes, there's a fair bit of premium revenue that is coming from there, but let's move this elsewhere and focus our attention, double down on the life business?
So Ram, I'll actually take you back close to, I think, late 22, early 2023, when there was an announcement, and we had the announcement from our group company, and that was Sanlam South Africa, of a joint venture between Sanlam, then it was Sanlam Emerging Markets, that's covering all the countries in Africa outside of South Africa, coming into a joint venture with Allianz. So both companies and both groups had been operating separately in different entities within the continent until that announcement was made. And the spirit of the joint venture was Allianz is a global giant in terms of insurance, and Sanlam, having had its roots on the continent for close to over 100 years, it then was ideal that the two come together and ideally then form a joint venture that would operate in 26 markets then across Africa to provide life insurance, general insurance, and investments. So at the beginning, the joint venture was 60-40, 60 to Sanlam and 40 was with Allianz. But then early 2024, that was improved to 51 Sanlam and 49 Allianz. And that really was where this conversation happened. So now coming into our market, then we do know that around that time when we were doing the announcement of the joint venture, Allianz had already come into the market and gotten to acquire the Jubilee General Insurance business. And so that then meant that with the announcement of the joint venture, that the general insurance business is within the Sanlam Jubilee, Allianz environment then would be merging. And that's ideally what happened. So this was a conversation that had started much earlier on. And the culmination of it was obviously the rebrand that we saw last year in October, where we rebranded into SanlamAllianz. And then that meant then that our life, general, and investment companies all rebranded into SanlamAllianz entities in their respective aspects.
How then should we be thinking about the group structure, the sort of earnings profile that investors should expect moving forward? Now that essentially this transition, this corporate reorganization has pretty much been finalized, what should we be expecting from SanlamAllianz as a life insurance firm?
So from our holdings perspective, and ideally the entity that is listed on the NSE, what then has happened is before the rebrand or before the activities that happened, Sanlam SKP had two entities or two subsidiaries. So there was Sanlam Life and Sanlam General. So effective on November last year, Sanlam General then was folded up. So it became a dormant entity within the holdings group. So the only entity that then is active within the group is now the SanlamAllianz Life entity. So then the Sanlam General, as we knew it, has become dormant effective this November. And all the liabilities then have been transferred to SanlamAllianz General, and that has been merged with the Jubilee liabilities and assets as well. So going forward, then the SanlamAllianz holding results will be mainly be contributed by the SanlamAllianz Life entity. Yes.
So in terms of comparability of results, I just want to go back to fiscal 2025, because at that point you had pre-tax earnings of 1.32 billion, a profit after tax of 830. How much of that can we attribute to life versus general insurance? What's the split?
So the bulk of it obviously was from the life entity. If you look at the life insurance results full year, the profit before tax was 1.36 billion. So ideally then from the holdings results that we saw, then the bulk of the results came from the life entity. And if you're to compare the results that we published, I think towards the end of last week, and I must say that it's a very complex transaction, looking at now the entities that are dormant and the active entities within the group. There was then a lot of work that had to go, especially for the remaining entities within the holding company, to ensure that the results to the shareholders would remain impressive. And so that's really what the work that went behind the scenes. So to answer your question, the results for the holdings company factored in a prorated return from the now dormant Sanlam General Insurance business for now 10 months there almost, and then full year results for the SanlamAllianz Life business. Rama, am I making sense? And it can be a mouthful, but that really is the result that we've seen.
That's entirely fine. It makes a fair bit of sense. We'll get into the specific business lines in just a moment. But with respect to the life insurance sector in general, because like you said a little earlier, you've been in this space for 20 years. Has it become easier to actually convince clients, to convince companies that, look, life insurance policies do have to be a part of your financial management practices pretty much across the board? Has that become easier over the years, or do you still run into a bit of resistance in the market?
The numbers are interesting, and we can always debate about my background being in numbers. I always look at numbers for guidance. Looking at the statistics, we've seen a steady growth on the life insurance space. So if you look at the IRA data, there are close to 20-25% year-on-year growth at an industry perspective in terms of the life insurance premiums and really growth within the space. In fact, last year then, actually the pie, or if you look at the share of life insurance to general insurance, then for the first time, life insurance contributed a slightly higher amount in terms of gross written premium to the industry compared to general insurance. So from that space, there's growth. But then when we look at the underlying other factors, when we look at life insurance and mission within the industry, and that's a standard practice in which you measure the uptake of insurance in any economy, life insurance is still quite low. It's at 1%. Also, out of the total 2.7% penetration numbers that we talk about of the overall industry, only 1% contributes to life insurance. So that tells us that there's so much opportunity in terms of growth for this industry. And there's still so many Kenyans, there's still so many people who have not been able to embrace or understand the impact of life insurance for them.
Why is that? What is it that's holding us back? Is it that typical thing that sometimes we see where we think about the short term, the immediate needs have to be met now. And those things, if we're thinking about life insurance policies that are over 10 or 15 or 20-year horizon, that's not really something that we're thinking about.
In my view, yeah, I think it's a mix of what you've said, customer behavior. There's also an aspect of understanding what life insurance should do for you. And there's been a lot of debate about what kind of products people should take. I've seen that a lot online. And also there is an aspect of the traditional products that we've had really resonating with the current customer or the situation of the day to day. So a lot of feedback that we get is clients find that life insurance is rigid. It's structured for a very traditional, ideal environment of someone who would have a steady income for 15 years. So there's a lot of predictability and assumptions that were used in our product design. That has changed. There's also a need of more flexibility, more transparency in products. So all that drama has really contributed to the slow uptake that I would say we've seen from the life insurance space. But that said, there is an increase of awareness. And I would say that there's been an increase in access to information and education of our customers on what it is that is available for them and what it is that they can access from life insurance. And this is actually attributed, in my view, this is just a personal thinking that I have as well, in a shift in even how our society has been structured. Before, traditionally, we had the net of family, community coming in when there is something that happens. When you need to educate your child, community would come together, put together resources, take you to university. It was a community project. But now, because of the pressure, economic pressures, that becomes an individual focus for people. In terms of wealth transfer now, the idea that maybe our parents had or a generation before had on how you can transfer wealth, how you can protect your wealth has significantly changed. So there's a lot of information, I would say, and a lot of ask to us as providers of life insurance to really match up to the continuous emerging needs of the customers. But that said, we have seen that there's been a lot of innovation, a lot of products being distributed, and a lot of conversations just trying to match that need. So I would say the future really just does look bright in terms of continued uptake for this our life insurance solutions.
And I'm not jumping the gun by going into product side of things in terms of service delivery, but to what extent does the friction of actually having to sit down and make those payments or thinking about, okay, how do I get the money from my account or my mobile money account to make these payments on a regular basis? To what extent can we sort out that friction by essentially embedding life insurance into other day-to-day transactions that we know that consumers do make? And one example I might give here would be, like we've seen, for example, on mobile money, the instances where a telco will say, look, if you make a payment, we can take X% of that and then put it into a savings account product. So stuff like that to lower that friction. And even though the individual in question may not have regular income, they'll still be making some payment of some sort.
Norma, you're right. Say, if you look at the products that have grown, and I'll just give an example. You've given an example of embedded solutions. A very simple one was Credit Life. So maybe 10 years back now, most institutions that were lending, when the innovation of unsecured loans came into the market, there was that concern of, if anything happens to this client, how do we recover the money that you've lended to them? And you do not want to go recovering money that is owed by a bank or a SACCO from a family that has just been deceased. So embedding, for example, Credit Life on loans has now become almost automatic for any financial services company. What that has done, if you look at the growth of a group, a Credit Life or group business as it is over the years, it's been phenomenal. But beyond that, and I always say that there's always the money, but there's the impact. The impact that has had is, first, financial institutions then have been able to build a level of confidence to lend to a wider base of the population, because there's a layer of risk that has been mitigated, whether it is death, whether it's retrenchment, whether it is an unforeseen circumstance. There's that layer. So what that has done, financial institutions then have been able to avail credit to maybe segments of the population that would not have had access to credit before. That's the impact of embedding, and that's the impact of simplifying the solutions. And that's just one example of what that has done for even just the wider economy. And so going into our next layer is, yes, embedding lost expense on telco products. We actually did one pilot with a telco provider where we embedded a credit life insurance on devices that people actually do buy on a day-to-day basis. And the uptake was just phenomenal. So you're right, simplifying products and creating and making them accessible, at the same time making them affordable, because affordability also restricts a lot of people from taking up insurance, and just being able to then give them that level of confidence and dignity that in the event something happens, is that layer that protects them. That continues to be from a company point of view as SanlamAllianz, because we are aware that a lot of people still, insurance is out of reach for them. They would want to save, protect for themselves and their families, but it's something that is out of reach. So creating solutions that are more accessible to the wider population remains a focus area, and we've been able to do a lot in that space. One of the key focuses for us, for example, is retirement planning. And we have been able to create a digital product that is called Akiba Plus, that anyone with as low as 200 shillings, 500 shillings can be able to set aside on an irregular basis. You do not have to do it monthly or weekly, as and when you receive an income, and you start building towards your retirement or your medium-term needs that you would have. So that is something that constantly keeps us awake, Rama.
Indeed. And just for reference for our listeners, the declared net pension return rate on Akiba Plus last year was around 14%, so a fairly decent return there relative to the industry. Let's talk about earnings quality for a moment, because looking at the company's result, we've got group profits before tax up around 110%, 1.315 billion shillings. But then if you look at net earnings, that only moved up around 2.4% to 838 million Kenyan shillings. What should we interpret as the key drivers here for these earnings, for these results for 2025? And I know IFRS 17 implementation is an ongoing issue across the entire industry. How does that factor into the numbers that we saw from last year?
Two things also I want to bring out for the activity for last year. So from a group perspective, Rama, you do remember also earlier on in the year, we had a successful rights issue. And ideally, what we wanted to do is to be able to capitalize the business, or to be able to de-risk our balance sheet so that we reduce the borrowings that we had, and we are then able to channel our profits towards reducing the retained losses that we've had over the years, building up a runway or a pathway towards now dividends to our shareholders. And ideally, that continues to be the focus areas. Last year was a myriad of many things for the holding company. So we had the rights issue, quite successful in our view, because then we were able to successfully raise capital from the public and from our shareholders. We were able to settle the loans that we had. There was the significant borrowing that we had been trying to offload for quite a number of years. And then we had the merger happening of SanlamAllianz, and obviously then the folding up of the Sanlam General entity within the holding group. So all of those were very significant in ensuring then that the holdings company continues to be profitable and can eventually generate dividend for the shareholder. And so yes, there was a slight dip, but I must say that from the earnings that we saw, the 832 million that we saw, it was then for us a very solid position in terms of ensuring then that we can build up on that in the next years to be then able to generate dividend for the shareholder. And that continues to be the focus of the leadership of the business.
With respect to future growth, because I know that the argument that the board is making, and the one you've made now, is, look, we're trying to essentially lay the groundwork here for future growth, which partly explains why there wasn't a dividend payout this year. Walk us through the medium-term plan here. What's the runway that investors should be looking at and saying, okay, you've built up this life business, we're getting X amount in regular premiums coming in, but when can we then expect this life insurance machine that is being built to start giving us a return?
Rama, that's a very interesting question. I don't know. But ideally, what I would say is looking at the fundamentals of the business, I believe we are now at a very solid position as a company. And if you unpack our financials and the reasons why for the last, I think, 6-7 years, we've not been able to generate any dividend, was any earnings, any dividend that we would generate from the subsidiaries would go towards servicing the loans that we owed at that time. And hence the whole reason why that activity was very important for us. Now that we are almost out of the woods, we are not yet there. If you look at our financials, we still have some retained losses that we need to still work on. But the whole idea is that given that the bulk of it is now sorted, we should then be working towards ensuring that we generate a dividend to our shareholders. And that is the core focus of us as management at this point. So a timeline, I would not want to say a timeline at this point, but I would want to assure our listeners that is something that we really can see now at the end of it from where we sit. And a lot of work is going in terms of building up the revenues from the life insurance entity. We are focusing on our strategy. We have a 3-year strategy that we started off this year, focusing on growth, customer, our people, and efficiencies that we'll build in. And so we'll continue to see a lot of innovation from us, a lot of engagement from us in terms of new things and new ideas to market to be able to then build up the earnings and be able to build sustainable dividend payouts to our shareholders in the near future.
I know when we speak about life insurance companies, it often feels like pigeonholing the firm into just thinking about life insurance. But obviously, firms in this space do a lot more. There's the savings products, there's pension products, and so on and so forth. Can you give us a sense of what the margins are like across those two specific areas, the pension administration business on one hand and life insurance on the other?
For us at SanlamAllianz, our margins are pretty decent, especially from those two products. And I'll zoom in onto two. So individual life insurance, basically the protection and savings product, and the DA, what we call the pension, but the deposit admin products really are our anchor solutions for the next 3 years, as what I said in terms of our strategy. And coming deeper into it, and let me just play the picture and then we'll talk about what it means for us in terms of margins and profits. When we look at the long-term nature of life insurance companies, you would want solutions that are able to resonate with your customers for the next 15 years that you have promised and committed to either give them. And I've just used 15 years as an example. It's all long-term. They're all very long-term solutions. And so even in terms of unlocking profits from this product, you have to have a long-term view. So we do not look at it from a short-term immediate return. Our focus is always, do we have sustainable products that will meet the customer need? Will we be able to meet the promise that we have given? And will we be able then to generate value to our shareholders in the long term? Because that really would be the 3 things that drives our strategy and what we're doing. And so for these 2 products, we have looked at that 3-point scenario. 1, are they generating value to our customers? I would say yes. And we'll continue to ensure that our customer then gets the best in terms of getting value from the ILN pension products that we give them. Are they generating value to the shareholder? Yes, but not in the immediate term. The profits that you're seeing, Rama, that we are posting are profits from business that we sold 10, 15 years ago. And one of the things that we monitor very closely in SanlamAllianz is a metrics we call the value of new business, where we assess the business that we are onboarding at this point. Is it going to generate profits in the future? And that really is what we measure, the sustainability of our business. And I can confirm that for these 2 products, we have been able to generate positive value of new business for the long term. And we continue then to measure and monitor that very closely. So I don't know if I've answered your question in terms of a particular margin you wanted, but I would want to confirm that we do monitor very closely. And in the interim, in the immediate term, the focus is the customer gets their value, but we create that balance with also ensuring shareholder gets value in the long term. Rama, we would not want to build a business where we scale up in terms of numbers, profits going up, volumes coming up, then in 5-6 years, it's all losses and problems. That would tell that there was something fundamentally wrong that was missed at the beginning of it all.
And the reason why I was asking about the margins question, because if you're thinking about expanding, in terms of expanding the reach that you have, getting a lot more clients and premium volumes going up, one of the advantages of doing business now is that we have so many digital touch points with clients that would essentially allow you to reach 1 million more people or 500,000 people with a much smaller cost base than you would have, say, 10, 15, 20 years ago when you got into the business. Is that where the opportunity is? Because now you've got this massive base of 30 plus million people in Kenya, for example, who are using mobile money services. That's a ready, accessible market. But you then would have to build out this entire digital ecosystem to get access to them, or would it make more sense to partner with a telco to get access to that market?
In terms of cost of distribution, you're right. And I think the partnership element then would be, for me, in my view, the best approach to look into it. Because we could build a digital engine, and we are building digital products and digital solutions and putting them out to our customers. But at the end of it, our clients also want, and that this is the experience that we have seen so far. And I'll give you an example. When we launched Akiba Plus in October last year, and in past 3 months, so up to December, we had 10,000 engagements. Now, that might look small, especially for maybe financial institutions that have much, much bigger banks and telcos. But for an insurance space, that is massive, because we had 10,000 in 3 months who went onto the platform, engaged with the platform, and said, I want to know more about the solution that you're talking about, the Akiba Plus. But majority of those 10,000 did not move to the next step until a phone call was made about a call center or an engagement was followed through. And that told us something about our customer behavior, that yes, digital does create access to our customers. Digital, you are able to get solutions or answers to whatever it is that you're looking for at the comfort of your home without having to talk to anyone. But for most people, they'll still want someone to tell them that you can actually complete this journey and this is what it would mean for you. And that's why I say then the aspect of partnership comes in. But that said, the scale that we are able to achieve in 3 months is something that we were not able to achieve by one-on-one. It's something that if we send our traditional distribution channels, we would probably achieve 1,000 a month. And this has scaled up. And then in this year also, we've seen further numbers coming through. And so we have to think about how do we continue to digitize our products, reduce the cost of distribution so that we can pass those benefits back to the clients. Rama, one of the reasons why insurance people say it doesn't make sense is that they'll do the math and I don't see the value of I have put my money with you for 15 years. I'm getting so little value. And there's always that debate. And the biggest concern has been the cost of getting that product to the customer. We have to create efficient ways in which we reduce the cost of distribution and pass that benefit back to the customer. And that's what digital does. I think the second thing I want to bring out is also the nature of life insurance in Kenya is you have to capitalize or you have to have sufficient capital as an underwriter for whatever products you want to give to clients. So for life insurance, for pensions, especially the DA product, then your capital is critical and the regulator actually mandates that life insurance have a certain level of capital to be able to distribute or underwrite some of this risk. Again, that is one of the key areas that we look at, and that's one of the focus areas that we look up to ensure that our capital adequacy is sufficient. At the close of last year, we're at 275%. And what that then tells any customer or any investor is that we are adequately capitalized to be able to underwrite the risks of these products, and not just for the near term, but for the long term that we are committing to and meeting the promise that we're giving, because we give a lot of promises at the beginning.
I know for some of the people who are listening to this, I know the argument they'll make is, going back to your question around the return that people get, I guess the baseline will be if I can invest X amount of cash in a 10-year or 15-year bond, what are you going to give me that's beyond that number? What's the alpha you're delivering on top of that to convince me to actually put cash into the business? Informal markets, though, I'm really curious about how you're going to penetrate the informal element of Kenya's economy. And the example I like to use is looking at the behavior of clients in medical insurance. For example, it's something that we obviously do need to keep up to date with our payments on. And looking at some of the old numbers from NHIF, at the National Hospital Insurance Fund, among their entire clients, the ones in the formal sector around 80-85% of them would be up to date on their premium. The figure for the informal sector would be much lower, around 25-30% at best. And for a whole bunch of reasons, we understand why the informal sector is usually quite difficult to penetrate, to convince people to put cash into. But is it still that problematic to actually get people to make those regular payments? What can be done to make it easier for them to actually come to the life insurance pool?
You're right. If we are to change the numbers that I cited earlier in terms of opportunity growth, increased penetration within our industry, we have to look at how do we get the solutions that we're distributing into the informal sector. When we talk of informal sector, the image that probably comes to our minds would be it's a very unpredictable sector. But I think it's all about developing products and solutions that relate and connect with this segment and making it easy and making our products accessible to them. And I'll give this example. Home fiber. If you look at maybe home internet and what we use at home for most of us in terms of internet, I would imagine that both formal, informal sector utilize internet on a monthly basis. And there's always that prompt at the end of every month where you have to top up and pay for your internet connectivity to continue using it for the next month. I would imagine that the success rate of renewal is quite high because the consumers then are able to connect direct gratification. I'm buying internet and I'm able to use it and see the importance of why I'm using it. So the reason why insurance has been not attractive to the informal sector, in my view, especially life insurance, is one, it's been structured for the formal space. And this is the conversation we have with my colleague when we're discussing products or when we're discussing solutions. We've come up with a product where you say you must pay it on a monthly, quarterly, semi-annual manner. And if you do not pay for 2-3 months, it lapses. And all that language.
When people hear something has lapsed, they'll be like, by now, really?
Yeah. Anyway, money has gone like that, and that's how we get insurance are all the things and names that you're called. And it's all because of how we structured the product. And so when we think about someone in the informal sector, this is someone who goes, gets a deal, gets an income that probably is meant, will push them for 3-6 months before they get the next deal. Their income is very regular, very unpredictable. They live in a very unpredictable environment. But at the same time, I strongly believe that the most liquid people are in the informal sector. The people who have the highest disposable income are in the informal sector. And so it's all about then how do we tie the solutions and needs? Is there a need? Yes. All these people want to ensure that they live a life of dignity. They want to educate their children. They want to retire comfortably. They want to be able to pass on a legacy to their next of kin and to the next generation. So they have the need. So how do we connect the need and their reality to the solutions that we give? And that has to be the continuous conversation we have as we create products. We cannot create products for the market the way we knew it and solutions and even set up then our systems and the way we operate as in. I totally agree with you. If we are to shift the growth, then we have to connect to the informal sector. Now coming home, and someone might ask, so Jackie, as you know this, what are you doing about it? And you look at the innovations we've been able to roll out in the last 12, 18 months or so, we have gone back to the drawing board and we are asking the questions that really apply to what is it that would meet this customer need and how do we then create solutions that relate to them. And we have to continue doing that. So the Akiba Plus is, we have a product we're about to roll out. We'll be launching it in 2-3 months, with a lot of flexibility and addressing the needs. The income drawdown we launched early this year to address retirement needs for those who are retiring. And we continue to ask ourselves, how do we meet this target market?
And that actually leads us nicely to a question from one of our listeners, Namsi Arena, who's asking you to speak a little bit more about Akiba Plus.
So Akiba Plus is, we want to redefine retirement. And ideally then what we said is, would want to create a platform that is accessible to any Kenyan who wants to start working towards, I call it medium to long-term goals. Because Rama, you'll agree with me, there's a lot of short-term products that are available. If you want to save towards a holiday in December or something in 6 months, 9 months, 1 year, there's so many products that are available in the market. And we've seen, for example, the popularity of unit trust and all this. But then we have medium-term, long-term planning. That's the first thing we saw. The second thing we saw is medium-term, long-term planning helps people to then repurpose. I do not want to use the word retirement because what people now are doing, if I'm working an 8 to 5, there is a dream that one day I'll be able to have accumulated enough savings for myself to be able to live the life and do the career that I wanted or do something that is passionate for me.
People really don't retire anyway.
Yes. Yes.
I still have people in my social circle in their 50s and their 60s who quote unquote have retired from their age to 5, but they're still doing stuff. Someone's farming, someone's doing consulting gig, someone pursuing their other things. Retirement, quote unquote, at least as we knew it in the 70s and 80s, doesn't really exist anymore.
I agree, Rama. And the reason why they are able to do the things that they're doing is because they are financially comfortable. Otherwise, if you've not set yourself up for that, then you'll probably continue pushing years at your workplace so that you can get that. And so you're right, Rama. And that's one of the things that we quickly identified. So how do we bring this to anyone, whether you're employed, self-employed, a young person just starting out in life? How do we bring that? The second thing then we've done on Akiba Plus, then, so we've allowed you to access this. It's an online tool. You go in. And the first thing you do is we allow you to dream. So we have this page that is called the Wealth Calculator, and we ask you to just paint the picture of what that is for you. So when do you want to stop working, quote unquote? How much do you want to be earning? What's your age? And you are then able to start saying, this is what I can do with what I have, and this is what it will mean for me 15, 25 years later. Rama, I can tell you the one thing that I always say when I look at that tool, I wish I am back to 25. Because the younger you are, it's sure you are able to build the dream life that you want with so little, but with the consistency and discipline that any financial success needs. That is ideally Akiba Plus. So it becomes then a product that you can save on, you can access and see how your money is growing. You can top up on, you can be able to then build on for your midterm to long-term planning. And I would encourage that you just go on and interact with it. And you're able to benefit from taxes because pension products in this country, you earn tax relief. So you are able to save off on tax benefits and tax relief benefits that you get and actually grow your money faster.
And just looking at the product portfolio, because the contributions that you're talking about, you're saying start small from just about 100 shillings a day. That's less than $1. And I'm just thinking about it in terms of, yes, we do want reach, but is there such a thing as a contribution being quote unquote too small to essentially make meaningful business sense for life insurance business? Or is this simply a case of even if the contribution per month, per day, whatever the is relatively small, if we have enough of them at scale, then the business, the aggregate premium revenue starts to make sense. Because with digital channels, obviously, that makes it a lot easier to have a lot more small contributions coming in on a regular basis.
You're right, Rama. There's nothing as something. I always say there's nothing as a too small contribution. I think it's Warren Buffett who spoke about this principle in investing. And it's really not about how much you invest. It's the discipline that you put in your investment. It's the consistency and the discipline that you put in your investments. And I'll give an example. When you do a simulation of putting in 1,000 shillings a month, that's $10, or maybe for those who are not Kenyan, a month, and you're 25 for 30 years, that sets you up for close to 10 million, 9.6. I think we did the math at just an average return of 8%, 8 to 10%. You'll get around 9.6 million in accumulated savings plus interest on over that period of time. So 1,000 might look small, but the power of compounding time and that consistency builds up a portfolio. And that's, I think, one thing that we need to discuss. Maybe we need to have another space to discuss about the patience that investing needs and requires and the consistency that it requires. Because of the nature of the society that we live in, there's always that urge to see what's the next big thing that can make me $1 million overnight. And so you want it now. And I saw this one is giving a 50%. Maybe I should try it. And yes, we are trying all those.
Why aren't you buying crypto? Why can't I put my money in there? Why should I be putting it into my pension fund? I'm just missing out.
Now I'm telling you, we always joke because when you sit in trustee meetings for pension, the people will tell you, me, give me this money. I'll go invest. You've given us 14%. To give me this cash and I invested it for myself. I get. So there's that. But any successful investor, time history has proven that there are just three formulas to successful investment: consistency, discipline. I guess discipline and consistency go together, and the value of time. And if we put that over the long term, you'll see the results. I encourage that. It's never too late to start, and you can never start too small.
What about risks? Let's speak about risks for a moment. In terms of risks that come with a life-heavy business model, from a population perspective, Kenya's population is relatively young. We're living longer. Hopefully, we're going to be working for a lot longer. And then if you look at the sort of assets that you have at this point in time, there's about 31, almost 32 billion shillings in government securities as well. How are you managing the emerging risks in your portfolio?
That question coming at this point, we are living in very volatile times. I'll just give an example. Starting the beginning of this year, we did not know that there would be another war yet again happening. At this time, I saw someone tweeting and saying that they've been planning and stopping how they planned a holiday. I think summer holiday. You pack, you unpack, you pack, you unpack, because you didn't know what direction this is going. And that's the reality of the world and the environment that you're operating in. And so as SanlamAllianz, the one thing first that we do is, and I said that before, the center of it is we have to put our customers first. So everything we do, every commitment we have made, we have to then ensure whether the risks that are facing us, the unforeseen, whether we saw it or not, that the promise is met. Because the last thing you want, Rama, is someone has placed in Sanlam their lifelong earnings, and one day we tell them, oh, sorry, this is not there. But that's not the scenario that we would want. So the risks are there. So that the global, the geopolitical risks are a real thing, and we continue to be faced with a very volatile environment. There's even just at a now customer level, we have now the need of customers who we're living longer. So there's a longevity risk. And I'm not saying that as a bad thing, is that then we have to always ensure that for the longer term commitments that we have given, we have to meet those needs. As cyber risks, there's so many risks that we're facing. But how do we mitigate these risks? So one, we are very deliberate but prudent to ensure that we create a sweet balance. Customers want the best, but they also do not want the risk. They do not want the risk that they lose all their money. We have to create that balance. How do we generate a highest return in the market? But we can still say, in the event of anything, you are safeguarded. That has to be something that you do on a continuous basis. So our investment strategy is we monitor it so closely, almost on a daily basis. We are guided by the regulator. So from an insurance perspective, again, there's a way we are mandated to ensure that we have invested the money that we receive from our customers, assets that we can put these monies in, the assets we cannot touch. For example, we are not allowed to invest in crypto or in certain commodity classes. So we have in Kenya a very limited portfolio in which we can put in and invest policyholder monies in.
Can you give us a sense of what you're restricted to invest in? Because I know there are non-insurance guys in the audience who'll be like, if I give you my cash, if I'm paying premiums, where is the money going?
So ideally, and the regulator either mandate to invest in government securities, or we are allowed in the listed securities, so that the NSC shares. We are a small portion on offshore, and you are then allowed to also invest in corporate bonds, but again, very limited. We're given guidelines to how much you can expose customer funds, policyholder funds, and property. That's the other one that I was forgetting. So if you look then at a lot of the insurance companies, when we are listing the assets part, then we are demonstrating or highlighting where we have put in the money. The other thing, Rama, is that over and above that, for what is considered the riskier assets, there's actually a capital charge that IRA, the regulator, would then mandate that if you have invested in what they consider a riskier asset, then you have a higher capital charge compared to the lower risk assets.
So by riskier assets, we're
Yeah.
talking about what these equities in this market, equities outside the market.
Exactly. For example, those would attract a higher capital charge compared to, say, government securities.
Just out of interest, what's the limit on what percentage of your portfolio you can invest in outside equities? Because I know there's some individuals in the audience at the moment who've been looking with a slightly jealous eye at performance of stock markets elsewhere. We're looking at the S&P 500 up around 20-something%, or Nigeria for that matter, 40% up. How much can you allocate to foreign equities?
I think for like pension funds, it's 5%, but it's very low. It's 5% of the fund that you manage.
Which essentially tells us the regulators looking at this and saying, we're here to preserve capital.
Exactly.
And avoid wild swings in the asset base of these life insurance firms.
And that's the spirit of it. Ideally, what the regulator wants to achieve is confidence in the industry, so that you do not want to expose policyholder funds to very volatile assets that would mean losses to customers, which would mean less confident to the industry. So maybe when we are a bit more mature as an industry, we have grown, and maybe like the South African markets, they are allowed to diversify a bit more. But you can imagine that penetration in South Africa compared to Kenya is night and day. But ideally, that's the whole idea, that the allocation of assets is very closely guarded and regulated by the regulator. And this is just to ensure then that policyholder funds are protected. And so, Rama, actually, allow me to say this, and it's always good because I am a big proponent of financial awareness literacy to our customers. So because of that, I always do then bring this to our clients. When you are taking an insurance product, do not look at it as a pure investment product. Life insurance policies are savings, ideally structured to be protection and savings products. If you're to compare that versus an investment portfolio where you are able to put in your high risk appetite, and then it gives you a suggestion of all the very high risk, high return portfolios you can put in your money, then you'll not get a like for. You'll always go like, this is a rodeo. But ideally, then what it does is we have tried, and what we continuously do is to say, we're giving you a platform to put in some money first to protect yourself and your loved ones, because that's the essence of insurance. And you can actually save some money while at it and get some money with return on it. But you cannot equate it to an investment product. And that's why I say, if you're to do that, look at insurance as a portion of your diversified portfolio. Have insurance, have investment, have your SACO, have your unit trust, have a bit of that in your portfolio so that you are able to balance your overall return. But at the end of the day, out of all those, the one that really gives you a safety net then comes through his life insurance.
Maybe we can do a separate session on the portfolio optimization for retail investors like ourselves. Jacqueline, I want to bring the conversation to a close with your thoughts around where we're moving to over the next 3 years. I know you referred to the 3-year strategy that you have at the moment and how you're executing that. But beyond that, where do you see the life and the pensions administration business evolving to over the next 3 years? And where are the opportunities that you think you can capture value and deliver returns to shareholders?
So I think the longer term, in my view, is that the prospects, the outlook for the life insurance, pensions industry, it's quite positive. And the reason I have that confidence is also just correlating with the emerging needs, even the government strategies around when government is talking about preparing Kenyans for retirement and, for example, revamping the NSSF Act to ensure that people are saving towards retirement. That's painful. That is a painful conversation, but it is a must-have conversation because the overall savings rate in our country at an individual level and at a national level, it's still quite low. And we cannot build a sustainable future for ourselves and for our children unless we have these very critical discussions. How do we ensure that we will be retiring with dignity, with an income, without having to rely on our children for an income? How do we ensure that we are then building, instead of the other way where we were inheriting to take care of our parents, we are then passing wealth and transferring wealth to our children and to the next generation? Then this conversation, and they have started. Rama, I see a lot of information on X, on Instagram. We have a lot of people now discussing this, and the younger people are resonating with the solutions. Before, it was all about, I will work, I will buy a shamba, 50 by 100, build, retire, but there's a lot of awareness that's come out now. So the outlook for the industry is very positive. I must say that the regulation has also really tightened. When the regulator mandates that a certain level of capitalization is held by the companies, it is really to build confidence and trust within the industry. When you look at the M&A activity within the space, and just looked at it from the last 4 or 5 years, how many insurance companies have merged, the very big mergers that have happened in our market are quite a number of them have been in the insurance space. A lot of the foreign investors coming in and seeing the opportunity in Kenya and seeing that there's really opportunity for growth in this space. So when I from a regulatory, from a national conversation point of view, from an investor point of view, from a customer point of view, there is a lot of opportunity that is coming through for the growth and the future prospects for insurance. And for SanlamAllianz, it's the same story. With the new brand that we have, the ambition is that in the next 5 years, we get to market leadership. And actually, the dream that we have is to bring a local solution with a global expertise to this market. And that then, we believe that it's going to really plug into the emerging and continuous needs and demand for insurance in this space. So Rama, it's very exciting. Obviously, our market is very dynamic. Our customers are also very dynamic, but I believe we're up for the challenge. And I would encourage all of us to engage with SanlamAllianz. I would not close this without saying, please visit us and look at our pages, look at our products, engage with us, look at what it is that we can do together. And thank you. Thanks you so much.
Indeed, just to answer some of the questions a little earlier from Namsi Arena, akibaplus.co.ke is the URL that you should go to, check that out, see how it works. And of course, this is just one part of a series of conversations that we'll be having around this. So the idea around holding separate sessions on portfolio management for small retail investors, but it's certainly something that we should be looking into in a bit more detail. Jacqueline, thank you very much for your time this evening. I know it's the start of a long weekend. Could be somewhere else doing something completely different. We do appreciate you taking the time to talk to us today. Jackie, say goodbye to the good people before I close.
Thank you, Rama. Thank you so much. And to our audience for dialing in and for just being very engaging. And as we said, we're open to always keep this conversation going for a personal level, from a company point of view, from an investor point of view. But looking forward then to the next session, and have a good weekend. Thank you.
Thanks, everyone. Thank you, Jacqueline. Enjoy your long weekend. We shall see you in the next edition of Mango Spaces.